The cybersecurity company CrowdStrike has grown its revenue by a compounded annual rate of 68% in the previous decade. That has investors excited about this business and are asking me if they should buy for 2026. I'll answer that question by looking at the company more comprehensively beyond just revenue growth and evaluate valuations to consider as well as profitability. We'll do all that in this relatively short video. Let's get into it. So as I highlighted in the introduction, CrowdStrike's revenue growth has been excellent, one of the best in the industry over the previous several years. Maybe SentinelOne is the only cybersecurity company I can think of off the top of my head that's generated revenue growth at a rate that's faster than CrowdStrike. The strong revenue growth rate has expanded its business from $100 million in revenue in 2018 all the way up to $4 billion in the most recent trailing 12-month period. Now, those increases in revenue have improved the company's returns on invested capital, but the overall figures are still relatively low. Its ROIC has expanded from negative 85% in 2019 all the way up to 0.8% in the most recent period, but this figure is still extremely low. At the very least, you'd like to see a company that generates returns on invested capital that exceed its weighted average cost of capital, and that's not the case yet for CrowdStrike. However, given its revenue growth trajectory and the structure of the cybersecurity industry, if the company persists in growing revenue at that rate, then of course it will surpass these levels. That being said, I don't think the company will grow its revenue at its historical averages. In fact, the company just reported quarterly earnings results in early December that demonstrated revenue growth slowing down considerably to just 22% in the most recent quarter. Now, I rarely ever say revenue growth of just 22% because 22% is excellent growth when you're operating a multi-billion-dollar business. But I speak like that when I'm evaluating a company that's trading at super expensive valuations. So when I'm evaluating an expensive business, I take a closer look at all of these little things, and I need everything to be perfect if I'm going to consider a super expensive business. One thing that is really good for CrowdStrike is its cash flow to sales ratio, which has improved from negative 50% all the way up to 35% in the most recent trailing 12-month period. Now, those figures had risen as high as 42%, but the company had to take some actions to mitigate some of the consequences from the outages it caused. Click the link below to watch the full video.